For investors, back in the day, like during the dot-com boom, finding a little company to invest in was easy. Everyone around then remembers taking a flyer on something.
It was a beer tap handle company. It was out of Edmonton, but because it was .com at the end, it was all the rage and failed spectacularly. But that would have been 1998 is when my first memories of real investing.
So beertaphandle.com didn't exactly work out. But whether it's a winner or a loser, you know what we have fewer of now? Canadian companies to invest in. Hi, I'm Paul Haberstrood. Welcome to The Cost of Living. On the Toronto Stock Exchange last year, only one company went public. The year before that, also just one. Canada's public market is shrinking, and some people are now starting to ring alarm bells. Also today, if you had braces as a kid, it's maybe not your favorite memory. Train tracks. The worst. Who would go to the orthodontist if they didn't have to? Turns out nowadays, a lot of adults. Up first, when you're stuck in traffic, what do you blame? Construction, more cars on the road, sure. But there's another reason. And if you're listening to this while driving, you may be sitting in it. So Jen, you and Danielle Nerman just took a little field trip.
Yeah, sometimes we leave the building. We went out driving on one of Calgary's busiest roads to conduct a fairly unofficial survey.
And we're just going to play a little game called How Many SUVs Can We See and Trucks?
And it was 4 o'clock, so rush hour.
So now we're stuck in traffic, so I can really count now. 1, 2, 3, 4, 5. No, I'm not going to count the Jeep. Jeep is just a fun car. All right. 6. It's getting busy. 13, 14, 15.
She's just racking up the SUVs.
Oh, yeah. It doesn't take long. So many SUVs and trucks on the road. But it wasn't always like this. We used to drive a lot more sedans and compact cars in Canada. I talked to a guy named Dan Illica about this shift. He tests cars for Auto Trader. And he says the change really started back in the mid-90s when automakers first introduced the Honda CR-V and the Toyota RAV4.
That was kind of the kicking off point for crossovers. But then with light trucks, half-ton trucks in particular, Ford, General Motors started to equip pickup trucks with more, luxurious features. So they weren't just work trucks. They weren't just farm trucks anymore. They were luxury vehicles. So that's when those markets really started to kind of come into their own.
Well, they're definitely into their own now.
Yeah. I mean, for comparison, 15 years ago, SUVs and trucks made up just over half of all the vehicles sold in Canada. Last year, they made up 87%.
This is not surprising because you look around, everything almost on the road looks the same. It's homogenous. Like what? Give me a coupe.
or a sedan. I mean, you can still find, I don't know about coupes, but you can still see sedans on the road. But SUVs and trucks, they're just more profitable. So automakers promote them. But also buyers like them. Like people often say they love the all-wheel drive. They feel safer in them. They love being able to see over other cars. Dan Illica talks to a lot of truck owners, and he hears this all the time.
My wife likes it because, she sits higher. So it's almost like that battle to be the tallest on the road. Trucks are getting bigger, so people feel like they need to sit ever higher. And I guess instead of a stack of phone books, people are just choosing F-150s.
I know people like to be up higher. My mom's one of those people.
And it's not just trucks that are getting bigger. If you look at the Honda CR-V, compared to a CR-V from 2000, last year's model is 7 inches longer and 4 inches wider.
And that also means the dealers can sell you on more legroom, more trunk space.
Exactly. And they can charge you more. But we are paying for our love of big cars in other ways.
And that is?
They are making traffic worse, especially in places where traffic is already bad. David Levinson is a professor of transport engineering at the University of Sydney. He says not only do trucks and SUVs take up more road space just because they're bigger, but they also make congestion worse because everyone around them gives them more space.
And by that you mean?
Well, think about what it's like when you're traveling behind a really big truck, like an 18-wheeler.
You're going to give it a wide berth. You're going to give it a wide berth when you're following it, and you're going to give it a wide berth when you're passing it because it's got a large mass. You know that if it has to slow down very sharply, that you don't have a lot of reaction time to it, and you can't see what's in front of it and what it might be responding to.
Oh, yeah. If you're driving behind like a bus, you got to stay way back, especially coming up on an intersection because you have to be able to see the light.
And David says with big SUVs, it's sort of the same process in miniature. Instead of traveling 2 car lengths behind, you might leave 2.5 car lengths. So David was thinking about all this extra space, and he wondered if it might be making traffic worse overall. So he set out to test his theory.
And he did that how?
Well, he worked with the city of Minneapolis and their traffic data, which goes back decades. And he analyzed traffic flow from 1995 to 2019. He studied the numbers during the morning rush hour when it was really congested. He looked at traffic density, flow, and something called throughput, which is the maximum number of cars you can move past a certain point in 1 hour. What he found is that traffic has slowed by more than 10%.
So over the 25-year period that we looked at, the throughput dropped from 1,850 vehicles an hour to 1,600 vehicles an hour. So that's a significant loss in capacity.
So basically these roads are just handling fewer vehicles.
And if you look at what people are driving, trucks increased by more than 150%, and SUVs increased by more than 1,000%.
So way more SUVs, way more trucks, and it sounds like he's drawing kind of a line between those bigger vehicles and more congestion.
Yes. Now, it's obviously not the only thing making for bad traffic. It's just one more thing. And it makes the biggest difference in places just on the verge of having really bad traffic.
If you take 10% off of your capacity, and previously you were a mid-sized city that was just under having, notable congestion in the 1990s, and the population doesn't change, the number of drivers doesn't change, but their cars change because the cars all get bigger. Now the same number of vehicles on the road is going to be congested.
So bigger vehicles, just enough to tip things over from freewheeling home in rush hour to gridlock.
And gridlock is just the worst, right? It's also very expensive. It's a big drag on the economy. A study came out last year looking at Toronto and Hamilton. It showed that traffic congestion is costing them as much as $45 billion a year.
Okay, so does your guy here who studied this, does he have any solutions?
Well, he is worried that if cars keep getting bigger, this is only going to get worse. So he really thinks it wouldn't hurt if we started buying smaller cars.
Okay, yeah, you know what? Jen, snap my fingers. Let's go. Let's make it happen. Everyone, compacts.
That's right. I mean, you can incentivize people to do that with money, making people pay more in taxes and fees for driving bigger cars.
Okay, so something like congestion pricing.
And some places are starting to do this. David Zipper is a senior fellow with MIT's Mobility Initiative. He says there are some neighborhoods in Montreal that are charging higher parking permit fees for bigger vehicles. And in Washington, D.C., they just brought in a sliding scale of registration fees based on vehicle weight.
So the idea here is to create a financial incentive to nudge people towards smaller vehicles and to basically address some of the societal costs that are imposed on everybody else when somebody decides to get an enormous truck or SUV for themselves.
What he's talking about here is what an economist would call paying for a negative externality. You cause someone else hardship, you pay for that.
Traffic congestion is one of those things, and pricing is a way to account for it.
No one's trying to say you can't have an SUV, I don't think. No one's trying to be unfair, but I think it's entirely reasonable to say, look, if you want to get a car that is going to consume more road space, it's going to slow other people down, going to put other people in danger, you're going to have to pay more for those societal costs. That's just the way it is.
This might be entirely reasonable, but I can't imagine it would be entirely popular.
No, but David thinks it would be good policy. Very similar to congestion pricing, which, there was so much pushback to that in New York City last year when they brought it in. But it is making a difference. There are fewer cars on the road in the inner city and traffic is flowing better.
Well, people don't like paying for stuff. Money can be a pretty big incentive, but would any of this really be enough to get folks to drive smaller cars?
I don't have a crystal ball, but I could see it being a tough sell. SUVs have got a lot going for them. They've got all that trunk space. We have a hitch on the back of ours, and one of these days I'm going to tow something with it.
But are you willing to pay for that privilege in the meantime?
Ooh, tough question.
Well, that, Jen, is where the rubber will hit the road. Thanks.
You're welcome.
This is The Cost of Living. Listen to us on CBC Radio 1 or wherever you get your podcasts. I'm Paul Haberstrood. Now, far be it for me to trade in stereotypes. So if this sounds like you, please take it with love. There's a cliche. A person hits a certain age. They buy the red Corvette, cruise around with the top down. It's the midlife crisis car. But these days, that's not the only way to turn back the clock. Now more adults, from millennials to silver foxes, are paying up to relive their teenage years in a different way.
Nathan Pilipuck always had a nice smile. But a couple years ago, he started having problems with his bite. So he got braces. The OG kind. Brackets and wires.
Metal mouth.
At first, talking and eating were painful, and his mouth just felt weird.
It felt like Halloween as a kid in the 80s being like a vampire, and you had those plasticky teeth on hinges.
Child of the 80s? Well, someone just dated themselves.
I am 45. Even my mom said, why are you doing this at your age?
Nathan is not alone. Of the thousands of people who wear braces, more than 1 in 4 are now adults. Just ask Corey Liss. He's an orthodontist in Calgary.
Adults are the largest growing segment of our patient population.
Dr. Liss says there's a lot of perfect smiles on social media. And the 20 to 30-year-old crowd, well, that's what they want.
Young people today take a ton of photos of themselves. I take one. Half the time I don't look, right? These ones are looking and scrolling and filtering them, and their community is their social community.
And then there was the Zoom boom.
People were spending more time on Zoom calls looking at their teeth.
They're like, oh yeah, that snaggletooth, where'd that come from?
Yeah.
But it's not just a young person thing. Dr. Liss treats about a dozen adults a day, and most of them are in their 40s and 50s. So does this mean braces are the new midlife convertible? Asking for a friend.
I've yet to meet someone who says they are foregoing their sports car purchase and instead they're putting it on their braces. But, I think we're spending our money differently. Before it was maybe acquiring things and maybe people wanted to feel good about themselves. Where do you look first? Eyes and smile, right?
And we're shelling out big to feel good. Braces can be a $5,000 to $10,000 investment. They're part of a growing trend where Canadians are spending more of their budgets on health and personal care. And braces are not as big of a commitment as they once were. Dr. Lilia McKenzie is an orthodontist in New Brunswick. She says clear aligners, like Invisalign, mean faster treatment time. Typically a year, sometimes way less.
An adult patient could have their smile back in 3 months or less.
Even if it takes longer, you'll still have fewer appointments than if you got old school braces.
So in my practice, I usually see my patients about every 3 to 4 months. Sometimes I can stretch it out to 5.
At the same time, with advances in technology, more general dentists now do orthodontics. And more competition means better pricing options.
We do interest-free payment plans that are spread over a longer period of time than the treatment. So sometimes the patient would be finished treatment in a year, but we would end up paying over 3 or sometimes 4 years.
Nathan Pilipuck is a few months away from getting his braces off. And as a part-time actor, he can't wait.
I might be reading into this. Since having them on, the only things I've been cast in, I've had my mouth closed.
So, no speaking parts, huh?
Once they're off, if I'm still not getting like any role with lines, then I'll know it's like me as an actor. It was never the braces.
For The Cost of Living, I'm Danielle Nerman.
This is The Cost of Living. I'm Paul Haberstrood. Tarek Jeusi started investing in stocks in the late 90s. This was the peak of the dot-com bubble. Back then, there were so many little companies. And yeah, he remembers putting a few bucks into something he hoped would hit it big.
It was a beer tap handle company. It was out of Edmonton, but because it was .com at the end, it was all the rage and yeah, failed spectacularly. But that would have been 1998 is when my first memories of real investing.
Yeah, beertaphandle.com didn't exactly work out, but
at that point in my life, it was trying to hit home runs and not really understanding investing versus gambling. There was a lot of hoping Y2K happened and, debts would get erased magically and credit cards would no longer exist, so whatever you had racked up. So I can't say that I was deep in the winners from the late 90s to the early 2000s.
Young Tarek wasn't exactly Warren Buffett. Since then, he has had his share of winners. And these days, where he's investing and what he's investing in?
For me, it's changed dramatically to 0 junior public startups, but many junior private companies.
So why isn't he investing in public companies anymore? Well, when Tarek looks at the Toronto Stock Exchange,
the opportunities aren't there. The stats speak for themselves. Junior companies just don't exist. There's just no new compelling stories for people to even be able to sink into.
Think about a small company with a big idea. When it goes public, it does an initial public offering, what's known as an IPO. That's when investors can get in on it, get a piece of the action. Its shares start trading, anyone can buy them, and then make money off that company's big idea. Last year, on the TSX, only one company went public. The year before that also only had one IPO. In 2022, it was 3. Look back to the 90s and things were different. IPOs were being churned out, like 40 a year. Dan Wilson was part of some of those. He's now a law professor at the University of Calgary. For a company back then, he says going public,
it was the dream. It's what you built towards from the day you had your eureka moment as to I want to build a company around this technology or this service or this idea. The idea was I want to build this to a size where I can take it public.
Dan says that's not the dream anymore, and he's worried about what's happening in Canada's stock market. If you look at the type of investments available on the TSX, it's a lot of exchange-traded funds, ETFs. But the amount of actual businesses that do stuff, that number has cratered. Compared to 2008, it's fallen by more than 40%. And we used to have 1,200 companies. Now it's around 700. The same kind of decline is happening in the US and Europe. Dan is among a handful of people in this country sounding an alarm. He says fewer publicly traded companies is bad in all kinds of ways. It's hurting the economy, making wealth inequality worse, and leaving Canada vulnerable. So why aren't more companies going public? Well, there are a bunch of reasons. But a big one comes back to the amount of private money now up for grabs.
We now have massive pools of private capital willing to take on deals that didn't used to exist, that are in direct competition with the public markets.
The amount of wealth now in the world has exploded. 30 years ago, Bill Gates was worth $12 billion. Today, Elon Musk is worth $400 billion. A lot of that new wealth that's been created has been handed over to private money managers, the smart money. They scour the world for the best investments. Add in low interest rates, and that has supercharged how much they can borrow and the size of the deals they can do.
Since the 1990s, the amount of dollars available through private investment sources has gone up by orders of magnitude, like by 6, 7, 8 times. There's so much more private capital chasing the same number of deals that it's now become competitive. The word is dry powder, and we're at like all-time highs in that. They're fighting each other for the good deals.
The reason any company goes public is to get money. The market has money, they need it, great match. But today, startups just don't need public markets like they used to. And if you can get private equity money, bingo, that's way easier. No shareholders to please or audited quarterly financial statements. Activist hedge funds aren't coming for your job. And then there's the regulations. When Dan started out, the book with all of Canada's securities rules was about 350 pages long. Now?
We had to go to 2 volumes because we went over 4,000 pages at 8-point font. The explosion of the amount of regulation, the complexity of the regulation, the cost of the regulation, the risk of being public for a business leader has become so much higher.
So being a public company has become harder. Dan says that's not great. Public companies can be really good for an economy. They tend to stick around for the long haul. The market gives them the incentive to get bigger, increase their share price, build an empire.
There's a whole, raft of data that shows companies who do IPOs, for the 5 years after their IPO, that is the biggest increase in their hiring. Like, they're the biggest new employers. It's also the biggest increase in new intellectual property development. So, economically, having companies who have gone through an IPO and have to now deliver to the market, those have historically been very, strong performing companies.
In comparison, private companies are often on a clock, 5 to 7 years. They hit a certain size, find a buyer, and cash out. It's what happens next that concerns Dan. Around the world, economic nationalism is on the rise. More countries are looking out for number one. And when he looks at who's buying our companies,
they are largely to American interests, sometimes to European interests, to Asian interests. Capital is global. And we live next to the largest economy in the world, which has infinite amounts of dry powder to buy Canadian companies. And if you are an American buyer, are you going to continue to push for your company to grow in Canada? Or are you going to be agnostic and you say, okay, well, that was nice, you got it to a certain stage, but frankly, we can do R&D cheaper in India, we can do it cheaper in China, and so, we'll keep the people in Canada who are there now, but all future hiring is going to be where we can do it at the best economic terms. That's loss of jobs in the future.
Little companies selling early also means fewer big Canadian companies. Big companies are big employers. They spend on research and technology. They innovate. Canada's economic productivity is thought to be falling behind other countries. And that would be bad for our standard of living. Dan argues fewer public companies, in it for the long term, is part of the problem. If we look at what fewer IPOs means for our personal finances, not everyone can invest in private companies. You have to be an accredited investor. You need deep pockets.
You have to be in the top 4% of households in Canada in order to invest in a private company. That means that the best, most attractive opportunities in Canada are essentially being reserved for those who already are in the top 4%. And the mums and pops and the school teachers and the firefighters and the plumbers, they don't have the opportunity to invest in those deals. They do not see those deals. They're not going to the public market, and they're frozen out of those.
So 96% of Canadians can't invest with this smart money. We have fewer options. Dan says this means the rich get richer and everyone else falls behind. If we want to change any of this, Dan Wilson says we'll need an overhaul. Canada will need to slash regulations for public companies, offer tax incentives, blow up the rules for investing in private firms. It's a lot, but Dan thinks it's something the country has to consider.
What we had hoped was short-term trends that would be reversed have become systemic changes that are going to continue, into the perpetual future, and at some point have very dire consequences for us, as a country, unless we reverse them.
In the movie Wall Street, Gordon Gekko says, if you're not inside, you're outside. Right now, a lot of investors are on the outside. It's kind of like the game has moved to a private club. They're not allowed in, and the economy, it could also be getting shut out. That's all for the show. The Cost of Living is based in Calgary. The show is produced by Danielle Nerman, Leah Hendry, and Jennifer Keane, with help from Jeff Kynock. And, at the risk of sounding like a cliched podcast host, if you get a chance to give us a 5-star rating, that'd be great. Just hammer that like button, folks. We'd appreciate it. I'm Paul Habersrud. Thanks for listening.